Kevin Kelly, Benchmark Investments Managing Partner, Oliver Pursche, Bruderman Asset Management Chief Market Strategist. You got a raise since the last time I saw you, Oliver. Chris Versace, Tematica Research Co-founder and CIO, Vincent Reinhart, former Federal Reserve employee, and York Mellon Asset Management Chief Economist. Hey, Chris, let me start with you because I think you were pretty optimistic over the last week. I saw some of your tweets, and I know how you operate, but people were scared.
Yeah, I think people were scared, Charles, and I think what we saw was a massive reset in expectations, really calibrating on two things. One, after that really strong January employment report, good number of jobs, wages looking to be a little stronger, people are starting to dial in the fact that the Fed might have to raise rates not 3 times this year, but 4 times. And I think that combined with the uptick in bond yields and treasury yields, people are starting to say, there might be some other alternatives out there. So a big reset to expectations. But I think we've seen most of that, if not all of it, priced into the market now.
I hear that's the narrative, Oliver, but I don't see where that's new. And also, I don't understand the idea that the Fed hiking rates because the economy is doing good is such an awful thing. And when did 3% yield on a 10-year become so attractive that you would abandon stocks?
Yeah, absolutely correct, Charles. And let's not forget, we were at 3% 10-year Treasury 5 years ago. So this is not the first time that we're at these levels. I think from an investor's perspective, you need to look at it from a percentage perspective, not a point. 1,000 points sounds like a lot, but when you translate that into 1.5%, 2%, that's not quite as dramatic. And at the end of the day, that's what we're talking about here. Today was a very healthy day for the market. You saw some ups, some downs, some shaking out of the dust, and that's important. The question is, what happens over the next couple of weeks? Do we stay in a trading range, consolidating? Do yields stay relatively steady? If so, then that's a very good sign for the rest of the year.
Kevin, 1,000 points to someone who's not paying attention to the percentages blows away the number one, the prior record. And that's what people see. 1,000 points. People were stopping me on the street. Felt like sometimes I'm in an airport, people remind me of a pick I had like 10 years ago. Yo, Charlie, what's up at Rite Aid? And I'm like, oh, okay, But people were like, what's going on here? We need help.
Yeah, I know. And I certainly got a lot of text messages, emails. I was up late last night just responding to a lot of inquiries. And one of the things that I told everybody is, listen, everybody's assessing the risk tolerance, especially after you have such a great January where you're up 4.5%. You annualize that 90% returns in the market, you're not going to get that. So when you start to see that the 10 years rising, you're starting to see wages increase. Those are 2 major costs to company, right? The cost of capital and the cost of labor. So everyone was really assessing that on Friday, and it stuck into Monday. But then you look, you got 17 times earnings for next year. Right. The global economy is growing. Right. And so it was just a reassessment of risk.
Vincent, of course, all eyes on the Fed. They've got a new Fed chief. And in fact, a lot of people say what we're looking at now has an eerie similarity to 1987 when Alex Greenspan got the job in that awkward point when the market was crashing and he had to make some really quick decisions. Do you see the parallels, and do you think we should have a different assessment of Jay Powell than perhaps we had a week ago? Because all of a sudden, it feels like everyone thinks he's some super hawk.
The world turns a lot faster because at least Chairman Greenspan had a few months to get ready for the stock market crash. Jay Powell, it happened on the day he got sworn in. I think this feels internal to equity and volatility markets. The revision, the news on employment just was a little bump that pushed markets down a steep hill. We got some shakeout. We have a
but what I want to ask you about, Vince, because you've worked at the Fed before. The thinking there, the market's pricing in 2, perhaps 3. I thought it would be at least 3 interest rate hikes this year. What would it take for the Fed to go to 4 interest rate hikes?
I'm on your page, Charles. I think they're going to go 4 times. What happened last year? Actually, the FOMC acted at all 4 of its press conference meetings. 3 times raising rates, 1 time announcing its balance sheet program. Once a body's in motion, it stays in motion. We have a forecast here that inflation picks up a little bit. The unemployment rate will be starting at 3. We're going to get growth in GDP almost touching 3%. The Fed's going to be able to renormalize monetary policy the favorable way. Right, every headline you will be reporting, Fed confident enough about the expansion to eat into the buffer.
All right. I mean, Oliver, you're shaking your head. You don't buy it.
Well, I think 4 is a stretch. I think 2 is almost a lock. 3 is probable. 4 is a stretch. Look, at the end of the day, we've got inflation numbers that are giving us a 1.8% year-over-year inflation data. Gold has barely budged. Yes, the global economy is growing. Yes, the U.S. economy is doing very well, and there's things that are being priced in. But, you know, the Fed clearly indicated yesterday that they are worried about a market collapse, about an equity market collapse. And so I think they're going to continue to be somewhat cautious and slow in raising rates.
When does Jay Powell speak up? I mean, we have Bullard this morning, but he was scheduled to speak. Does he come out, you know, and say something soon, or does he just wait?
I think he waits till the March conference and notes, the FOMC meeting. I think there's no win for him to come out earlier, because it would be viewed as a sign of almost panic or worry by the Fed, and that's the last thing you want.
Chris, let me go to you on this. The market, the volatility that was non-existent. In fact, in many ways, I say last year, could rank as one of the best markets ever if you not only take the gains we had, but the lack of volatility. I mean, it was really like sitting on a hammock somewhere in this cool breeze. And now this breeze has turned into a hurricane. How do people adjust to that? How do investors, particularly those who've just gotten into the market, adjust to that?
Well, you know, it's funny, coming over, somebody asked me that question, and my quick advice was, you know, stay the course. If you're an average investor and you're dollar cost averaging into your retirement funds or putting money in the market, stay the course. For other people that are a little more active, like you and I, Charles, that are buying individual stocks, you know, look, you've over the last couple of days, you've built your shopping list. You've seen companies like a Universal Display, a Dycom, and Applied Materials that have great tailwinds pushing on their businesses. You've seen their prices come in. You know, people like that are going to, again, you and I are probably licking at our chops to pick up these quality companies at better prices.
So these are names you like right now: OLED, Applied Materials, AMAT, and what's the other name you like, Chris?
Dycom, DY.
DY. Okay, and Kevin, I want to ask you about that too, because some of these stocks, I think the one caveat I would add with some of these names is that they can be volatile, right? They can go up 10 points in a session and down 10 points in a session. And that's probably the one thing people are going to have to understand when they buy these names, even names with the great growth that Chris is talking about. It comes with some added volatility they're not accustomed to.
Yeah, especially over the last couple of days, if you're not used to this, where we went 410 days without a 5% move. We finally got it, and everyone was worried about it. But why don't you seek refuge in names that are impervious to really a lot of volatility, that don't have to worry about the Fed raising rates, right? So if you look, the Fed fund futures only indicating a 25% probability of 4 hikes, but say it does happen, right? Go into a Microsoft that has net cash, right? They have to deploy that cash in raising their dividends, more buybacks, or doing a strategic acquisition. Look at a name like NVIDIA, which consistently grows because they're on the leading edge of chipsets for AI, for autonomous driving. So there are names you can get into that aren't going to be affected by extreme volatility, as well as, you know, they don't have to worry about the debt cycle.
Periodically, the shorts try to gang up on NVIDIA, but they've crushed them every time.
Every time. Look at the chart. Don't fix what's not broken. NVIDIA is just like Amazon 3 years ago when they were deploying Amazon Web Services.
Last word to you, Oliver.
Strong earnings growth is key. That's it.
Bottom line.
Bottom line
is the bottom line.
Bottom line is the bottom line. Strong earnings growth. So look for companies that are growing revenues at double digits, have strong free cash flow, and improving margins. You find those, you've probably got winners.